I will record this if you don't mind.
Yeah, that's fine.
Some students may not be able to follow classes on real time, so I just keep a backup.
Yeah.
And I will share my screen with you, so you can show things if you want to.
Yeah. No, don't worry about it, because I was planning to actually just go through a few things, and as I come through, I'll send across any materials that people might need afterwards. I can't actually see anyone. This is very scary if I don't see people.
So class, can you just switch on your video?
I'm not that scary. I'm less scary than Deguda.
Of
I
course.
promise.
Can some of you switch on your videos so that ma'am can see you?
Wonderful. That makes it easier, because otherwise I'm like staring at a blank sheet of people, which is very, very scary, actually. Okay, so as I'll kick off, what I thought would be quite useful is just going through some of the core principles of risk management. What I then want to do is actually spend some time on just the different types of risk management that you sort of tend to face. And I've literally not worked anywhere other than Morgan Stanley Risk Department from the time I passed out of ISI. So it's been my first job and something I've been doing for the last 13 years. So I'll give you an overview of the different types of risks. As I go through the different types of risks, what I want to actually spend some time on is identifying, what kind of problems do you face when you are trying to measure it, right? Like, what's the key things that you have to look out for as you're trying to measure them? And then what I do want to sort of end at is some of the really new, interesting types of risks that we're actually looking at. And I'll cover through some of the, the traditional market credit and other different risk types as we go through. So that's sort of what I'm structuring the lecture as. Is there anything any of you specifically want me to make sure I cover as I go through this, and these dying questions that you really hard to ask somebody who's doing in financial risk? I'll try and cover it. Is there anything like that that you would want me to sort of touch on? Now you're even asked to speak. That's hard.
So are there any topic which you want her to discuss in particular?
They're noddings of heads. They go there.
Yeah.
I am still more scary than you are. I'm trying to turn it, and at the end.
It will come.
Okay, fine. Okay, so because none of you told me what you want to hear about, what I'll try and go through is sort of what does risk management mean when you're in the middle of a crisis, right? So we were in the middle of a financial crisis back in 2008, which was probably when I started my career here. What does risk management actually mean when you're in the middle of a pandemic, and how do you sort of, what kind of risks are you actually sort of thinking through, right? So I'll sort of cover off some of those, what does it mean to do risk management as you're going through some of the scenarios during this process. Okay, so first, sort of the basic sets of principles that you follow when you're thinking about risk. So I tend to think about risk as this little Venn diagram, right? Risk never exists in isolation. Risk always exists as a combination of two things. First, especially if I'm thinking financial risks, first, it's how much money I'm going to make to make a certain amount of, and to make that amount of money, how much resources do I have to sort of put at risk. So there are two different concepts that come with each other. The first one is return. The second concept there is how much resource do you have. So resources can be things like capital. So I have, I don't know, Diguda gave me 10 rupees. I wanted to go buy a lottery ticket, and that's the risk I'm actually taking. The underlying 10 is the risk that I'm actually sort of putting at there. And my hope is that that 10 becomes 1,000, right? Um, I know I'm putting it in the context of a gambling, but in reality, that's what you're actually doing, right? So if you're doing futures, you're essentially saying at a certain future point, you will have a certain value to whatever that underlying asset that you're actually dealing with. And so you're putting in a certain amount of your money at risk. And so risk basically never exists in isolation, and it's always in the context of all the other risks, all the other components. The three, I call it the three R's. So risk, return, and resources. So there's all those three things together is quite important. And the reason I sort of stress on that right at the start is actually the fact that when you're trying to understand risk, it's never about the absolute value. It's the relative value on how much are you getting in the context of what you've come through. So a lot of the conversations we would be going through is actually saying, okay, let's say you have a future here on an equity, and you have, on the other hand, you've given a loan to a government agency, right? So you sort of have a two really broad spectrum of very different financial products. And in one, you are dealing with an equity and the volatility that's associated with an equity. And in another, you're dealing with the underlying credit risk of a government. So assuming that the future is a much smaller size, whereas the loan that you're giving is a much larger size, you would still actually give the risk. The more riskier association is actually the equity, and vice versa, right? So the size becomes, given the size, it may be that you are actually getting through the entire concept of what you're thinking about risk. And so you cannot actually pick one versus the other without understanding the concept. So risk pretty much always exists. Thank you, Vijay. Pretty much always exists in the context of the other two. So that's sort of the first thing to always remember about any risk management problem. It's about having all of those three things together. The second thing I'll say is, how do you go about doing risk management? Like, what's the sort of, if you cut all of the various different things that you do into the bare bones, what are the core things that you need to be actually looking out for? So, so the first thing you need to be looking out for is identification. So, is this a problem or is this not a problem? So, and that question keeps coming back again and again and again as you think through the different aspects of any financial risk. So I'll take an example, right? So let's say the only trading I'm doing is on government bonds, right? Like it is Indian bonds that they have issued, the government bonds that they have issued, or my mom's got an account at the postal office, right? Like one of those elements. Do I think that's risky? Is there any risk associated with it? This time I'm going to force someone to open up and say something. So what do you think? Do you think that's a risky asset? So you actually essentially have Indian government bonds with you, whether that's a post office deposit or, one of those sheets that you get that now I forgot how they even look at this point, because they've been in the post office for so long. Is that a risky proposition or no? Anyone? Okay, I'll pick on someone who hasn't opened their thing. Ian Paul, what do you think? Is that risky or no? Where is he? There he is.
I think it's less risky.
It's less risky, agreed, but it is still risky.
Maybe there is a small amount of risk.
Perfect. And what kind of risk?
That I don't know actually clearly.
Good. So I sort of at least know, thank you for that. So I at least know the things that I should be sort of touching on as I go through each one of them. So no, sorry for picking on you. Thank you. You were great. So the thing there is, what's the riskiness underlying what you're sort of looking there is essentially the question of whether our government will actually be able to pay. All right. So if you go back to your basics of economics kind of a class, there were times when India's sort of current account deposit wasn't enough, or there was just too much inflation in the economy. It may be that we had to send our gold, our gold reserves to somebody else to actually print the money, etc. So at a certain point in time, even governments actually are risky, less risky compared to any equities that you would sort of come through. But it's if the government, it's essentially, it's a promissory note, right? Like, I promise to pay you back blah and blah if you give me this amount of money over a certain long period of time. So the government itself might not be able to pay. Even if it pays, the inflation would have been so high over the last few years that what your mom thought would be enough for her, retirement is just not enough, because it's becomes, the value of it that you've got has actually become so low. And finally, it's also that essentially this thing. He's folded up in like 15 different directions and put inside such a lovely box, and the moths eat it away. This wonderful promissory note that we have. So operationally, we don't know how to actually put it back into a government. So all of those elements are the risks associated with having this little promissory note that's there. Now I see people are coming online, so that I don't pick on the people who are not, right? Don't worry, I'll do it the other way this time. So that's sort of what I'll call the identification phase of any risk. So given any financial product, and you would have learned everything from the futures, the derivatives, the options that you're sort of associating with it in the broadest sense, the loans, the funds in various shapes and forms, any one of them has certain risks associated with them, and pretty much the first thing you actually have to do is to figure out what are the key risks that are associated, and the context in which it's operating is quite important. So for my mom, the promissory note is is still a risky thing. For Mukesh Ambani, I don't think he cares, depending upon the size that you're dealing with, right? Like, imagine they were both of the same value, the risk is very different for the two of them. So that's pretty much the first part of it, which is the identification. The second part of it is the measurement, which, depending upon the risk type, and I'll go through this as we go through the different types of risks that are associated, it is actually quite different. And, you sort of have to understand what kind of problem you're actually solving. But it's essentially put a number to this, like how risky is it? You then go on and actually do, and when we think about risk management, and for sort of the practitioners that we are, we would sort of spend a lot of our time and energy on the third part of it, which is, think of it like this little dashboard that they show in all the movies, right? Which is monitoring the risk, right? It sort of doesn't matter that it's okay at a certain given point in time, because the risk is something that's constant. Financial markets change, your exposure to them changes, and also just the environment and the relationship between different variables actually changes, which means that you have to sort of monitor the risks associated with all the different components of it. So that's sort of my third one. And then the last one is about how do you manage the risks? So this is where I think the core of the syllabus, which we all go through, which is really about the derivatives. And where is this? This wonderful book of options, futures, and other derivatives has Digoda told you that you should stare at this one yet or no? This is I'm pretty sure he told me at long ago that I should be staring at Hull and White actually in the start, and Hull now.
This is Hull, right?
Yeah, it's Hull essentially. So
Well, I did ask them, but I'm sure they haven't.
they haven't. Yeah, no, this is like the first book that's readily at hand among 10 other things that are there. That's probably the one thing that's sort of readily at hand. So that's the Bible. However old you grow, it's sort of still something to stare at. And essentially what this one does is sort of goes through each and every derivative, helps you understand what the concept actually is, and how do you come about how do you sort of understand the maths that's associated with it, and then really how do you manage it. So at different points in time, I would say I've referred to that book as a different person. It's like the feller of my world, let me put it like that. So maybe that's an easier way to describe it. You that book goes with you as you sort of try and find different problems. It'll still be there to help you sort of think through things. And the reason I bring up that one is actually in managing the risks, you are typically asking the question, what can I do to sort of reduce the exposure that I have? And one of the biggest biggest available elements, and which is what's the essence of the derivatives, is actually the use of derivatives arises from trying to mitigate that risk. So in the concept of derivatives, like I was talking about futures, so it arose from the commodities world, where people are sort of trying to say, well, I don't know how the weather is going to look like, or the rainfall is going to look like over a certain period of time. So I will say, okay, you and I make this arrangement that in a month's time, when my crops are ready, then you will pay X amount to me. And by doing that, what the person who is actually producing, he's mitigated his risk, that things don't happen as he wanted, and he would still get a certain price that he's hoping for. And so that's sort of one inherent implicit arrangement for thinking about managing risk. Other more direct ones is if you've come across what is called a CDS, which is essentially a credit default swap. The way I think about it is an insurance product, and all it's saying is, let's say I know that I would I took some money from Deguda for whatever reason, and Deguda is worried I would default and I wouldn't pay him back. So he would go and buy a credit default swap on me to sort of make sure that those two things sort of align themselves, and he doesn't actually have the exposure associated with it. So what I've just covered there is different types of risk management approaches. And at the end, he can also say, you know what, Mitra, just pay it up. So he cuts his positions, or he goes to my husband and says, can you give me some more collateral, because I'm not sure whether or not she's actually going to pay back to me. So that's another way of reducing sort of exposure. So all of these different types is how do we manage the risk that's associated. So you have this wonderful dashboard where there are all of these different kinds of risks that are sort of flashing green and red and all of that stuff. So when it's flashing red, what do you do to actually manage it? And that's essentially my job, right? Like that's the thing that I end up doing day in and out, which is sort of saying, okay, I have this entire Morgan Stanley's portfolio, which trades anything that moves, as we call it. So if you sort of have this entire portfolio, how do you identify the risk? How do you sort of measure the risk? How do you then monitor it? What are the key things to monitor? Because it can, as you can imagine, it can get very tricky. How quickly, which ones are important and which ones are not, where do you have to keep your eye? And then finally, what do you do to mitigate that risk, right? So how do you manage it? How do you mitigate that risk? What do you need to do to actually go through with it? Pretty much any risk management problem, you can sort of cut it down into these 4 steps, right? I'll get killed by certain risk management professionals just for sort of simplifying the world too much. But you know what? That's what the abstract actually looks like. So those are the 4 different things to sort of go through. So now that we've got through the abstract, I think I'll just go in and start talking about the different types of risks we are actually associated with. Before I do that, I'll see if there are any questions. So who wants to sort of who wants to ask me a question on just the abstract? So first, risk never exists in isolation, which is the risk return and the resource idea. And then the second one is how do you go about doing risk management, which is, the identify, measure, monitor, and manage risks, right? So pretty much those are the 2 key principles you need. And then everything else sort of moves in from there. Somebody called Abhinandan left when I'm just about to ask the question. So they could just remind me, next time you're in class and you're asking him, you ask him 2 questions for me.
Yeah, will do.
Difficult ones. Okay, thank you. So who's on the list? So maybe Shweta? Yeah. Yay. The one girl in the class at ISI always.
No, we are 2 girls now.
Wow, that's very exciting.
We are Vaishnavi.
Where's Vaishnavi? Is Vaishnavi on today? Oh yeah.
Yes, she's in class.
Vaishnavi is on.
Wow, I didn't actually see that there was more than I assumed there were 9 people, and I didn't see the rest of you. Okay, the rest of you is coming next. Go ahead, Shweta. Any questions, anything that wasn't clear?
Not till now. I would just like to hear more.
Okay,
I'm interested
fine.
on the topic. I'd like to hear.
Wonderful. Good. I like you even more. Sujoy?
Yes, ma'am.
Any questions?
No, ma'am, not until now.
Not until now. Okay, fine. It was too nice. Okay, so then moving on to sort of the different. Yep, sorry.
Ma'am, could you please elaborate more on CDS, credit default swaps?
So, so a credit default swap, like I said, is essentially the market for it started in around the early part of this century, or pretty much the last end of the 20th century. And the idea is that it's a way to mitigate what's called as counterparty or credit risk. In terms of what it's actually trying to do is to sort of say, well, if this person or this institution, typically it's an institution, if this institution, whether that's an industry, a company or a government is about to default, then what is the amount of premium do I need to pay so that I can get back whatever my exposure is to it, right? So that's really all that a credit default swap is modeling. Now, this becomes a very interesting financial modeling problem, right? Because then you're actually asking the questions. There are two key questions you're asking: when and whether the institution on the other side is going to default. So you get into survival probabilities and sort of, whether or not they're going to go through. So you sort of have to model that aspect of it. But then the when is actually equally important. So imagine I say in 10 years it's going to default versus something's going to default today, then they both have very different values that it's still to an extent an optionality, right? So it's an insurance product, and that can sort of go through in two different ways. The underlying modeling is actually very similar to what you would do in insurance modeling, right? Because essentially the problem is the same. When and whether a person would die is the question you're asking in insurance, and here you're asking the question when and whether would a company default. So the principles and the actual modeling of it is very similar in both of those cases, and essentially that's what it's sort of actually grown out of. But these are tradable products, so you can actually see the level of spread. So if you take an example, say European government bonds during the heights of 2011. So the CDS spreads on 2011. So spread is the way you sort of measure how far it is away from the base of a certain level. Usually German government bonds is a good starting point. So the spread of it is sort of inversely proportional, rather directly proportional to the probability of default, and those spreads blew up sort of pretty much to a point that nobody could even see what it is, what it looks like for say countries like Greece, which were pretty close to default. So so first of all, it's an insurance product in the financial industry. And then the second thing that it's actually to keep in mind is it's a tradable product. So you trade it on various avenues, mostly bilateral between different counterparties, and the spreads are a really good way of actually seeing how big the probability of default is. That's one of the things that will be on the monitor that I described. How credit risky is a company, including how credit risky is Morgan Stanley itself. So that's what CDSs are all about. So I'll move back to talking about the different risk types. And one of the things that you'll see as we sort of talk through some of the risk types is actually thinking about how do you measure the risk? And I'll spend some time on how do you measure the risk and how can you actually mitigate some of the risk types. So first and foremost, and probably the easiest thing to understand, is market risk, right? So this is how much does the market value of a product go up or down, and what does this mean for me? So for any of you whose fathers, like mine, actually sits in front of CNBC for most of their time, would know what I'm talking about, right? Which is sort of saying, we've invested in a certain equity, and the price of that equity moved by X amount, and that is the risk associated with it. So sometimes you get a return, so it goes up, you get a return, so it goes down, you get loss. And again, you can sort of go through all of the different types of it. So that's a very linear relationship, right? Like for equities, that's a very linear relationship if you sort of just straight owning the equity. As soon as you get into all the fun stuff about the derivatives, it can go because of the, remember the profiling that you do on, those wonderful graphs where, you have a call option. So actually when the price goes up, then it's sort of, what do we call it? The payoff profile is in a certain way. And, it's sort of flat on the other side of it. So if you think about the market risk associated with an option, depending upon where you are on that profile, you would get a very different answer, right? So the point being is, as the markets change, you actually end up getting different losses that are associated with this entire spectrum that you're considering. Now, some key questions and some sort of ordering of riskiness. And I think Ian sort of brought it up before, which is, the government bonds, etc., tend to be the least risky of the different kinds of products that you're dealing with. And when we say they tend to be the least risky, typically we tend to mean they're the least risky from a market risk perspective, right? As the values of the underlying products go, your basic ordering looks like, well, if you have any credit instruments with a government, then they tend to be the most risky. And the credit instruments could be sort of bonds or any loans that you have. Your savings accounts, for example, is a financial product that's actually relatively less risky, which is why we sort of put in and get no return out of it. So which is another thing to sort of keep in mind. And then the full spectrum, you have something like equities where you can put in the money, you can probably make a lot of money out of it if you were sort of investing in Reliance or a small shape of Reliance and it keeps going up. But there is the other side of it, which makes it quite risky, which sort of it goes down. Or in this new world of things like Bitcoin, where things move on every given day by, I don't know, thousands of percentage points on either side. So they are the most risky as opposed to sort of the less risky. And if you think about even within the space of equities, which I find probably the most intuitive, if you look at developed market equities or what are called as typically blue chip equities, they tend to be much less riskier when you're thinking from a market risk lens on, because the volatility that you tend to see with them is lower than what you would see in an emerging market equity system. And that is sort of it's just quite important to understand that full spectrum of risks that we are actually looking at. So any financial product, you can broadly speaking say, credit tends to be less riskier than equities. The higher the sort of and some of this is intuitive, right? So the more you know the product, typically it tends to be less risky. And more riskier otherwise. So if you're having a small company in a private equity or a venture capitalist, that tends to be a much riskier side of the proposition. And as I said, when you're doing derivatives, because of the various kinds of payoff profiles, etc., and the fact that there is this pretty much by design, these kinks in the payoff profiles that you would sort of go through. So until a certain point, there's no risk associated with it. And beyond that, it either becomes too much or too little, right? Like you sort of have this, by almost by definition, a lot of risks associated with it. So just moving on onto the measurement side of it, and this is when it gets quite interesting, right? Or at least for me, it always got really interesting at the measuring side of it. So what kind of data would you need ever to measure market risk? Essentially, a time series of everything that trades, right? That's really the key data that you need. And depending upon the frequency of the product that you're dealing with, then at least at that frequency, typically daily, but sometimes you have to start thinking about what happens intraday, and certain instruments you sort of actually have to start thinking intraday, or certain instruments don't actually move. So if you sort of package up this world of mortgages, so all of us took a mortgage to buy a house, and you sort of package the whole thing up, and you create a new product, which is typically called as a securitized product, then those securitized products only move once in a month or a couple of months. And so, the underlying frequency of getting this data or this time series data is at a month, for example. So essentially, it's a time series modeling problem. It's typically a relatively short time horizon. So what happens within a day? And so really, you're looking at the time series. For any one of them, you're looking at the time series, drawing that wonderful graph, and seeing how heavy the tails are, and you're asking the question with a certain probability, which is say 95th percentile, then how much can I lose at that probability for a given time series that you're looking at. So if you're looking at one unit, then you're essentially doing that problem that says over this horizon, at a 95th percentile, how much can I actually lose? So you're modeling the tails, and you're trying to get a huge time series of data that comes through. And I would say that the data typically changes once every day at least. And so a very short time horizon you're sort of coming through. And so here, the problems tend to be more around having too much of data, trying to know what the relationship between the different variables actually come through. As you can imagine, as people who are doing MSTAT, and you can sort of remember all the correlations and all of that fun stuff, right? So if you do each one of these, imagine there are like, I don't know, hundreds of thousands of these time series variables. You can't do them one by one. Right? Like if you do a 95th percentile for each one of them and try and add the whole thing up, that's just not a sensible thing to do. You sort of have to find a way to aggregate these different elements. The minute you aggregate them and try to find a distribution across all of the different variables coming together, you very quickly get into the problem of correlations. So how correlated are different variables? Is there a directionality that's associated with it? How can you sort of reduce the dimensionality of the problem that you're sort of dealing with here so that you can get these numbers very quickly? But at the core, it's it's a simplified extreme value problem, right? Like over a certain period, what is the actual loss that you can get over at a certain given percentile? And that's essentially market risk, right? Again, I've oversimplified, but that's really all you need to know about market risk. How do the markets move, and how can I measure it? Comes through this process. I'll quickly move on to doing credit risk. Now, credit risk traditionally arises when somebody gives somebody else a loan. All right. So somebody borrows from a different person, and the person who gives the loan is worried whether this person is going to pay you back or not pay you back. So the default that we were talking about when we did when we were touching on CDS. So how and if you are a bank or an investment bank in our case, you give out loans to a number of different people. So in that context, it's always about what's, if you're a retail bank, then you're saying, okay, I have this whole population of people I'm giving out loans to. Will these guys come back to me and pay this money back to me or not? Right? Same problem as we had in the past. But here's the thing. When you're thinking about credit risk, you're essentially thinking about defaults, right? Would a person go through or not go through? And so the statistical problem that you're dealing with here is very different from the statistical problem you're dealing with in a market risk sense, right? Almost by default, because defaults don't happen every day. They happen, it's a 0-1 problem. It's the whole, imagine in your head sort of all those wonderful Bernoulli trails and toss a coin and it happens or it doesn't happen, all of those things, right? So that's what defaults modeling is all about. And they tend to happen over much fewer times. So the events that when you see them happens much fewer times throughout this whole process. So the modeling here, you typically want to get about a couple of really important things. What is the exposure that you have, which is how much loan have you given to the other person? That's probably your most important variable. And then the second most important variable is what's the probability of a default, right? And so you look at an aggregate. If you're a retail bank, you look at this aggregate set of people. You sort of tier them by, I don't know, income. And if you're a good bank, no other variables. But if you're not, then you try and sort of get other variables like, okay, this person lives in this area. That area isn't great, so don't give him a loan if they say in that area. You're not supposed to do that, but people still do it to an extent. But if you essentially what you're doing is credit scoring or the credit worthiness of your counterparty, which is why when any one of us have to apply for credit cards or any of that stuff, then you have this credit worthiness score. And it basically means, how do I, am I as a bank ready to sort of lend to this person or let this person borrow from me? So it is actually about getting the probabilities of defaults. But now think about how do you model this, right? So at a very simple level, you could say exposure times probability of default, and you're sort of done. Right, like that's sort of your loss modeling when you come through with it, as long as you can estimate that probability of defaults well. But actually what gets quite interesting is, how do you do it when you have a pool of people? How do you do it when, the exposure or the probability defaults are actually quite interlinked to one another? So I'll give an example, and the credit default swap is a really good example where certain things like that happen. So what might actually happen is that and this comes up when you're doing financial derivatives a lot more than if you're doing a straightforward loan. So what happens is, let's say, the credit default swap that we have is an euro-based credit default swap. And it's a credit default swap on, let's say, Spain or Italy. Right. So what happens in a crisis or a European crisis? Well, the underlying probability of default of Spain is increasing, right? So your it's getting less and less credit worthy. But the second thing is also happening. The actual credit default swap, or the value that you're going to get when this thing defaults, is in euros. So it so happens that the value of euro would also be going down at the same time as when credit worthiness of Spain is getting worse, which means that the exposure, which is one of the first things that I said, is that we have two things: the exposure versus the probability of default. These two variables are now starting to get correlated. That idea is what is called as a wrong way risk. And it's the underlying risk of the exposure and your probabilities of defaults actually being linked to one another. And you sort of have to go through with it. Now, again, going back to the basics and thinking about how do you measure, model it. So again, conceptually, you're still getting to the same point, right? You sort of have to get to over a certain horizon. And horizons in a credit world tend to be much longer, because on a day-to-day, you don't see a lot of defaults. It's typically a year as opposed to a day when you're thinking of market risk. Digudha, I've got, what, about 10 minutes more to go?
There is actually no restriction, because today this is the only class.
Oh, wonderful. So if you guys are okay, then I'll probably go about 10 minutes over, because we started about 10 minutes later. So there you're thinking of a longer time horizon. It's still an extreme value problem, and that's common across all risk types. But in coming up with it, you sort of have to think about how do I get the probability of default, and sort of do this mathematically simple version, which is PD times your exposure, and sort of add them up on my entire portfolio and get an estimate based on it. Or you do the other side of it, which is you simulate this underlying variables, which and have an event type of probability. So think of a Monte Carlo simulation that you're essentially doing, and you sort of say, okay, if this variable, like say spread levels are a good proxy typically, if the spread levels for whatever reasons go above a certain level, then the event of default actually happens. So you're sort of modeling the defaults and then actually coming up with what this associated credit riskiness is actually coming through. So in terms of modeling, again, it's slightly different, but the key difference comes from two things. One, that you're doing an event-based modeling, which is over a longer time horizon, and this hope to find about PDs. And then the last thing is your exposure and your probabilities of defaults can sometimes get correlated, which means that you can't do both of them in isolation. You actually have to model them together and to bring all of these components together and then find whatever is your extreme value you're looking out for. Again, so at the core, that's your credit risk problem, right? Whether somebody would default, and when they default, how much do you lose? You get quite technical very quickly here, and you get into, how much is your loss given default? How much is your jump to default? So if suddenly somebody defaulted, that loss is very different when you actually have some time as they're defaulting. So the time component actually becomes quite important, which is why, again, the Monte Carlo simulations versions actually work slightly better than the simplified PD time exposure methods, simply because, there's no concept of time that you can take into account. If you're doing a PD, you can have approximations, but not great. So that's sort of credit risk for you. I'll then move on to do two others, which is liquidity and operational risk, which again, I won't spend a lot of time on, but they're probably, so in traditional risk management, people spend about 90-95% of their lives on doing market or credit risk. So credit risk first, then market risk. But it so happens that most banks either fail because of the two others that we actually talk about, which is liquidity risk and operational risk. And I'll define what each one of them actually are. First, the liquidity risk, which gets bucketed along with market and credit as what are called as financial risks, and then operational risk tends to be the non-financial risks, as you sort of in the finance language. So what is liquidity risk about? So I tend to do this with an example. So the first one is, so imagine I I owned an asset like a house or something. So my net worth or my net value is actually quite high. But then when I have to pay back somebody, so say the Guda again, and I don't have enough money in the pocket to actually pay this back, right? So it's not about my net worth, but it's actually about how much liquid instruments or liquid cash do I have in hand to sort of get through whatever those things are that I need to get through. Anil Ambani is probably a good example of what I mean, right? It's not like he doesn't have things that are valuable with him, right? His net worth is still pretty high. But the problem that you have is that he doesn't have enough liquid net worth to sort of pay off his debts or do whatever else it is. And so if you think about, I'll start with the credit side of the conversation that we were talking about. So you define default as the inability to either either be unable to pay or not have the willingness to pay, right? So both of those things. Sometimes it may be that I just don't want to pay it back. And if you run out of cash in your pocket, you don't know whether the person is just unable to pay or he doesn't have the willingness to pay. And so in some sense, that's also considered as a default. In fact, pretty much any bank default, take the Lehman crisis, where Lehman actually defaulted, comes out of a liquidity problem. It's not that you don't have enough net worth, it's actually that on a day-to-day basis, you made certain commitments to sort of meet certain requirements and you run out of the cash to sort of pay that. And it's that you think of as a liquidity crisis. So how do you define this? Essentially, there are some incomings. So you get money for doing X, Y, and Z. And then there's some outgoings. You sort of have to pay your debtors. You sort of have to do X, Y, and Z. If that flow does not match up, then that becomes a risk. Right? So you sort of every day, and that's when it starts getting linked with your market and your credit risk and all of the other pieces, is that this flow should every day actually match up. It should match up not just in one currency. So imagine I was getting a lot of money in USD, but I need to pay out in INR. And I don't have enough cash in INR, and I don't have the ability to actually shift it into INR in a short span of time, then you actually have a liquidity risk there, because I don't have the right kind of currency to do the transaction in. Right. So liquidity risk is about matching the flows of what comes in versus what doesn't come in. And making sure that it sort of comes through. So taking the Lehman example as why I would call that a liquidity crisis rather than a credit crisis, while they're all linked to one another, is so what happened with Lehman is every day for most banks, the operations work like this, right? So they have to go out and buy certain trading or have to go out and give certain loans or whatever else it is, there's a market called as what is called as the repo market or the repurchase agreement market. So you basically agree the day before that, you would purchase this amount by this time. So it's like a secure, what is called the secured funding lines. And everyone was so worried that Lehman's going to default that nobody actually agreed to have a repurchase agreement with them. So essentially, they didn't get any funding for a very short period of time, which is what actually killed them. Right. So now again, moving on to sort of having identified the risk itself, what's the measurement? How do you measure liquidity risk? This is when it gets really interesting, right? Like you have to take into account the market shocks and the market prices and how things move. All right. So that's one factor. The second factor you have to take into account is, how what's the credit worthiness of yourself versus what's the credit worthiness of the person on the other side, whoever is on the other side of it. So you are considering the credit features associated with it. But the third thing, which is probably what I find the most fascinating thing about it, is you need to have assumptions about how people behave in a crisis, right? Because under a crisis, certain people may not actually lend me money because, I might be impacted, or the other side. So sometimes it might happen, there's a crisis, and actually what people do is withdraw their undrawn loans. So a lot of people, you have loans with companies, so you give loans and they may not actually take the full loan at one go. They'll take it when they need it. So in a crisis, they might all need the money all at the same time. So they're drawing out all at the same time. So your exposure goes up. And so if there's a sudden draw on your loan, then it's an unexpected a draw. And so you have to get cash to actually give this back. So there's a liquidity flow associated with it. Or it might just be that you don't have, Turkey is a great example. So sometimes almost quite recently, Turkey has come very close to what is putting capital controls. So in a country, they basically say, we won't let you take out our currency from the country. So there's, you sort of put constraints on the amount of capital or currencies that can get out of that country, which suddenly means that to actually source a Turkish lira becomes very difficult. So I might have all the cash in the world in every other currency, but I don't have Turkish lira. And so I actually suddenly am defaulting because I don't have the right kind of currency in that unit. So in some sense, what gets quite interesting about liquidity risk is it's about the balance of the flows. So you have to understand what's coming in and what's going out. You also have to understand, the market prices, because given the market prices, this what's coming in and what's going out can actually change quite materially. You have to understand sort of the credit worthiness changes. And then finally, what you actually have to understand and at least have some assumptions on is how do other market participants actually behave during this process, because the behavioral elements is what makes it really, really tricky to actually model and actually put a sense on some of this. It's still a similar problem, right? It's still how much can it's not lose, but how much shortfall will I have? So unlike market or credit, it's not about how much do you lose, it's about how much shortfall would I have? And modeling it needs some of the techniques on the others, but actually needs a bit more. And typically we tend to use various versions of stress tests to run it, because you essentially have to say, imagine all of these people do this, then what happens? Imagine this happens, then what happens? And you sort of have this whole spectrum of different ways of actually assessing what liquidity risk might look like. I'll move on from liquidity quite quickly into this world of operational risk. Now, operational risk I find properly fascinating, right? So here, I mean, you could probably get to a 0-1 kind of a modeling or an event modeling, but the idea is the following, right? Like, yes, you have to do X, Y, and Z, but people type something in wrong. So there's a fat finger error. And that blows things up. So in London about a couple of years ago, there was this thing called as the blue whale. So essentially, the first thing that we were talking about, the VAR modeling that we were doing in market risk. Somebody in JP Morgan basically didn't do that well, and it meant that the amount of capital that that entity needed should have been 3 times the amount of capital that you would have done if you didn't make that mistake. So it's the operational errors that are associated with it. It's also things like insider trading and fraud and cyber. So it's this whole spectrum of all of the other kinds of risks that you can't actually model, which is based on traditional prices, etc., that you would be coming through with it. So the key kinds of risks that happen there are things like business disruption. To think of the pandemic this year, right? So one of the first things my company and every company on the world has to do is to sort of ask people to go home and work from home. We've never tested 100% of our people working from home. So how do we know that the systems that we are using are actually safe? How do we know that we're not sending off information to different people in different ways? How do you know that this whole operation can still actually run? And if it doesn't, then what's my loss that's associated with it? Like, how much revenues do I expect to lose at the back of it? The other big one, especially a very interesting idea, is cyber risk. So any big company these days essentially has something like about, at a bare minimum, something like about 100,000 hackers trying to get into their systems every day, right? Every day. Any big company, that's sort of the statistic to keep in mind. Now, some of them get in, but they can't actually find their way around. So they, you sort of have to figure out, okay, they're like these they're like these parasites is probably the best way to put it. They're these parasites that are there, but they're not harmful. 1 or 2 of them may get through and really bring things down, right? And it's those 1 or 2 of them that you're actually looking out for. So, what kind of protections do we all have to put in? Because there are government-sponsored hackers. There are these people, there are these kids who just for the first time are actually trying to figure out, this sounds interesting. Let me try and figure out what hacking actually is. Right? Like just see if you can get through things. Or you can, or you get this whole spectrum of people who are, internally they're within the sort of the organization sometimes to sort of, help somebody else. They didn't think it was like that, but it was just trying to figure out how those pieces would come through. And you have this whole spectrum of different kinds of actors that are coming through. What does it mean to actually not make that happen? Bank of Bangladesh, again, a couple of years ago, no, actually about a year and a half ago now, lost a lot of money because the hackers sort of stayed in their systems for something like 8 months before they actually hacked, and they rewired their payments from Bangladesh to somewhere in Philippines. And the only reason people could find this was because somewhere in the Fed, they sort of have a Fed is the essentially the US regulator. So they found that, there's this really big discrepancy, and Bangladesh would never do something like this. And so they stopped it halfway through. And then when the analysis comes out, one of the things that that you find out is actually Bank of Bangladesh had a real risk management issue here, because the way they would check whether or not what they're sending out is via printing it. So they would print it every day, and they would get like, here are the things that are going out. And you can imagine this, right? If you went to the Allahabad Bank at ISI, you can sort of imagine these thousands of papers people print to see whether or not this is actually working. And the printer broke. And so they were like, okay, so it's not printing, so what, we'll be fine. But what people realize afterwards is what one of the things that the hackers had done is waited about 6 months, saw their patterns, and actually stopped the printer from working, so that that risk cannot be managed by looking at it. And so they put in a blocker for that to happen, which, it goes back to, what do you do? How do you sort of different types of risks need different types of risk management. So that's sort of the wonderful world of cyber risk. And so operational risk has this whole spectrum of things that can go wrong and different types of risks. And so modeling it, especially at the long end of the tail, it has the one commonality with credit risk, which is that, you have a bunch of losses that are every day. So there's this recurring amount of losses. Every day, somebody or the other makes a mistake. And there's a small amount of loss that will come out associated with it. What you then have to avoid is, you have to take that for granted. But then over and above that, you have to make sure that no one of these big events, and the event itself is not well defined in this case, unlike in credit, you know what the event is. It's a default risk. Whereas here, it can be anything from a basic PE system not working to an insider fraud to a cyber attack. And any one of these events can actually give you a loss. So again, it's extreme value theory modeling, longer horizon, but in the short horizon, you have this wonderful idea of, you'll make losses every day because you're going to make mistakes. So take that for granted. And then the second part of it is, how do you avoid the big ones? And to identify, measure, and actually capture some of the big ones is really what's sort of super interesting. I'll pause there. I can go on and talk to you about 10 other different types of risks, but I think those are the 4 that actually really matter. And, sort of take any questions.
So are there questions? There are many issues that are new that I understand, but I think it's a good time to
I have a
start.
question. So, like, how easy is for like these IBs to detect insider trading? Like, it seems like very hard. Like, and like I can get some very few amount of stuff. So, what's the cutoff after which they actually try looking for such things?
Yeah, I think that's a really good question. So insider trading was probably among the more difficult things to look out for, even probably 5 or 6 years ago. Now, actually, as we get closer and closer into the surveillance world, it's relatively easier to pick up insider trading, relatively. Still not perfect. What you tend to see is a certain kind of patterns, right? People are very close to they hold it very close to their heart on certain books that they are sort of looking out for. When they go on holidays, they never let other people look at certain components of it. There is sort of either, in counterintuitive things that you would tend to see. So either very high or very low risks on products that shouldn't have either high or a low risk profile. So there are these pretty much these telltale patterns, which, various basic AI/ML algorithms are now able to capture. So in some sense, actually that problem is becoming much more easier as you can find enough patterns of how you can identify this. So again, there it's how do you, your question's more about the identification part of it. How do you find where that issue is? And then finally, you sort of have in areas like the UK, for example, there's this concept of a senior manager regime where you basically say, if as a manager, if you are if something happens below you, you are equally liable. So the managers sort of make sure that their people are sort of being sensible and would highlight the patterns much faster. So if you put personal liability on people, things move. Who's asking me the next question?
So you mentioned that like big companies, they do like there are thousands of hackers, they hack in, they try to find what the problem is. What about the small companies? What kind of solutions do they come up with?
I don't actually know, and I'm not a cyber expert or anything in any way, shape, or form. But so my sense is there are two things, right? So the big companies tend to get a lot more for a good reason, which is that if you hack the British Airways site, which actually happened, then there's more publicity. So a lot of this is actually about publicity as much as it's about actually wanting to do something. So if you do it on a small company, then do people really care? Do you get as much bang for buck? So maybe there's just natural selection problem that smaller companies face a bit less of it. But it's sort of different elements, and again, different types of companies have different problems. One of the really interesting things I've heard is actually that in some of the newer companies, it may even be harder to try to sort of go through with it. Why? Because take a bank. They tend to have a lot more of legacy systems, etc., as opposed to sort of a new startup where they would start from the available technology, etc. So there may be those natural balances against them, but every company these days has to worry about cyber in one way, shape, or form or the other. And everyone has to think about there are these tools that's now externally available to sort of stop things happening, not just companies, governments, right? You can easily hack into certain elements from what I understand. But hey, none of you try it. Any more?
Any other questions? So Abhinandan is back online, so you can ask him.
Okay, Abhinandan, now that you left, tell me everything there is to tell me about, I don't know, which one should I pick, people? Liquidity risk.
So I got disconnected at that point, and yeah, I thought that would be the perceived sense that I got disconnected at the exact moment when you were speaking.
I see. Okay. Okay, fine. It was disconnection. Zoom does that to us sometimes. I agree.
So I was thinking about one thing, that is so you are saying that so for instance, if a bank, so if everyone who has a bank account, so say for example, everyone who has a bank account with the State Bank of India today goes and asks for their money, as it would happen in a crisis.
Mhm.
State Bank would not be able to give them back their money that they are in their account, right?
Yeah.
So the banks would always try to portray a confidence level to their customers than they actually should, than what they actually, then what is actually bad, right? Because if people think that they should not be confident about that bank, that increases the chances of they going bankrupt in that sense. So
Yeah, I think that's a really good question. So that concept that you've just talked about is everyone withdrawing their money. There's this lingo for it that's called the run on a bank. So a run on a bank is when people withdraw their money in panic. So if you know when the whole Chanda Kochar issue was coming up, there was a bit of a small worry about a run on an ICICI bank, as people were sort of trying to withdraw their money because they weren't sure whether or not there was anything left out of it, etc. Now, first things first, on savings banks accounts, for something like a state bank, etc., all of us have a natural insurance that's associated with it, which means that until a certain amount is reached, then the bank will pay it, or because it's government sponsored, the government will pay you for a certain level, right? So till, I don't know, whatever the number is, say up to 10 lakhs, everyone will get back their money. So, to an extent, there's this mitigating risk that's actually associated with it. And to your second point, which is about would the banks generally tend to portray their creditworthiness much more than they actually are? That's a more difficult question, because I think two things. In the long run, if you just keep portraying like people, right? Like if you keep portraying something that you're not, then you'll get found out. And then you lose your credibility even faster. Um, so you have a number of checks and balances for most banks, whether that's internal audits or external audits, or credit agencies who would actually review it, their own sort of management boards, etc., who should actually be reviewing and making sure that it comes through, etc., etc. So there's this whole mechanism of how you manage the risk by sort of having other independent parties reviewing and making sure that that actually works. And so I don't believe that any bank can portray that they are much better than they actually are for a long period of time. So essentially, all you really have to do is to bring up your defenses and make yourself stronger if you really want to make sure that there's no run on the bank. Of course, you can do it for a short period, but it's not going to stay.
I mean, as customers, we do not know a priori whether the bank has short-term interests in mind or the long-term interests, right? And so, if it is not risk mitigated by the government, then what exactly makes us have confidence in the financial agency?
Yeah, I think that's fair. As customers, you don't know, but think about it the other way around, right? So, on one end of the spectrum, you are putting your savings account into this bank. And on the other hand, the bank is actually giving your parents sort of a mortgage. So if you compare those two sort of gives and takes on the bank's assets and liabilities, which number is bigger? Typically, the mortgages do tend to be sort of slightly higher than the other way around. So the bank must be more worried about you than you are about the bank itself, just as an individual. But it's true, right? Like you don't have the a priori knowledge, and for any credit, what you're basically identifying is a credit problem, right? For any credit that you do, you will never have the a priori knowledge that this other person may or may not default, or whether this other person has the right intentions to pay you back, which is what makes it interesting, right? Like that's where the risk actually is. And the bank is only one example of it, but it's always true. Abhinandan has got like 10 more questions to ask me.
No,
But he's like, okay, I give up for now.
no, it's fine.
Anyone for any more?
All right, so I guess there are no immediate questions, but if there are questions later on, because some of these models they haven't learned yet, uh, so if there are questions later on, will you be willing to take emails?
Absolutely. If they're not difficult questions.
Okay, so then I will pass them on to you.
If they're difficult questions, I'll pass them back to you, Diguda.
Okay, all right. All right. So before we close, I will just share my screen for 15 seconds and show you three things. One is this book. So Sanghamitra talked about extreme events, rare events, really big risk. So this, according to me, in my personal opinion, this is still the best book. I think she is going to show you a physical copy.
Yeah, I think I do have my physical copy. Do I
This
have the
is
same
the
one? Or
best book that I know of.
now I had this one, Diguda. But I'm going to assume it's okay. We both have similar ones.
Yeah. So this is a very, very good reference. The other thing is we talked about credit default swaps. So this is John Hull, 10th edition, chapter 25. This talks about the credit default swaps. And as she has mentioned at the very beginning, that Hull is like, the Bible that you always want to keep with you. So this chapter talks about CDS. You will get some of the details. And incidentally, I did have Hull in my syllabus. The reading material syllabus that I shared with you, that actually had Hull here. I don't know whether you have opened it yet, but it will be there always. All right, so I'm done regarding lecturing today at least. And I would like to thank Sanghamitra, thank her a lot for waking up at an ungodly hour. It's like 7 o'clock in the morning, and I actually made a mistake in calculation. I thought it's 8 o'clock, but
no, it was my fault because we changed time. So so that was my start for the day today. So I was like, yeah, I'm going to be there at 8 o'clock today, so that we get through the lecture. But what I forgot was that in the UK and most of the Western world, we have this concept of changing time. So we change time twice a year so that you get more sunlight. In India, you don't have this problem of needing more sunlight at any given point, right? You get sunlight all throughout the day. Whereas here, you sort of have to maximize the amount of sunlight you get. And so once every sort of 6 months, we would change it. This weekend was the day it changed. So I completely forgot. And I was like, okay, so I still have an hour to go. I'll go talk to Diguda. And Diguda is calling me at like 7 o'clock in the morning. Like, what? Why are you here so quickly, Diguda? So that was my excitement. The one risk I needed to manage was look at time, and I didn't. So,
Anyway, thank you so much. And also Shubho Vijaya to all of you once again.
Shubho Vijaya, everyone. I'm sorry you couldn't all go pandal hopping this year, but I'm sure, Calcutta is looking equally beautiful during this time.
All right, so
bye-bye. Sorry,
our next class is on Monday, so there is no class on Wednesday, as I said. So we meet on Monday, 2nd November, and then it will be business as usual.